Dave Ramsey is one of the most well-known figures in the world of personal finance, and for good reason. He's helped countless people to get out of debt and start turning their financial lives around. But while few people would argue that getting out of debt, particularly the high-interest debt, is a bad thing, even if some might approach the goal in a slightly different way than Ramsey does, there are many that say that Dave's advice around investing is something that you should steer very clear of. But is that really true? Is Dave Ramsey's investing advice really all that bad? Today, that's what we're going to try and find out. I'm going to take a look at the investing portfolio that Dave typically recommends to see if those claims actually hold any water. Let's talk about the pros and the cons of the Dave Ramsey portfolio. But before we get going, be sure to like this video if you haven't already, as it really does help out the channel a lot, and subscribe with notifications on for more money-related videos like this one every single week. And if you want to further support this channel, you can check out some of the links I've left in the description below, which includes a link to the investing platform M1 Finance. Get started investing for free today. So the Dave Ramsey portfolio can sometimes seem a little bit nebulous. He's very consistent in saying things like once your non-mortgage debts are paid off and your full emergency fund is in place, you should be investing 15% of your income equally into 4 separate categories: growth, growth and income, aggressive growth, and international, but it can be sometimes a little bit difficult to determine what mutual funds actually fall under those categories. Thankfully, there's a handy article on Dave's website that gives us a better idea of what he's going for with this approach, entitled How to Invest in Mutual Funds. According to that article, growth and income funds are there to create a stable foundation for your portfolio. They're generally those big, boring, blue-chip companies that have a long history of stable growth and paying dividends. Typically, they fall under the large cap blend or large cap value categories. The growth category typically features large or medium-sized companies that are currently experiencing growth. They aren't generally as stable as those in the growth and income category, but they do have the potential for faster appreciation. Typically, these companies fall under the large cap growth or mid cap growth categories. The aggressive growth category is the most volatile of all, typically comprising of small or mid cap growth stocks, or sometimes even emerging market funds. The international category is pretty straightforward, and is specifically there to ensure that you don't put all your eggs in the basket of one country. In this case, the United States. I should note that some people use the term international, foreign, global, and world funds interchangeably, but there actually is a difference. An all-world fund, or a global fund, will have investments in places all over the world. International funds, or foreign funds, tend to exclude certain locations, such as the United States, which is what we want in this case. Dave generally doesn't recommend buying bonds, so we can assume that the international category would take the form of some sort of international stock fund. So there we go. We've got 25% of our money going towards large cap blend or value funds, another 25% going towards large or mid cap growth funds, 25% going towards small or mid cap growth funds or maybe emerging market funds, and another 25% going towards an international stock fund. Now there's obviously some overlap, so you could build this portfolio in several different ways. For this particular video, I'm going to try and balance the investments across these categories as best as I can by putting 12.5% in both a large cap blend and large cap value fund, 25% in a mid cap growth fund, 25% in a small cap growth fund, and 25% in an international stock fund. That allows us to have 25% of our money going towards large, mid, and small companies, with the recommended 25% going overseas. With that being said, let's see if Dave's portfolio really is as bad as some people say. As usual, we'll start by analyzing its historical returns. To analyze the returns, we'll be looking at several different metrics. The short and long-term inflation-adjusted returns for every starting year for which I have available data on all of the assets, in this case since 1970, the risk-adjusted returns, how often the portfolio loses money on an inflation-adjusted basis, and how severe those losses were, and of course how dependable the strategy is based on how sensitive those long-term returns are to when you decide to start investing. So, based on the data I have since 1970, the average 40-year inflation-adjusted return for the Ramsey portfolio is about 7.2% per year. Its worst case return was around 5.2% per year, assuming you began investing in 1970, which incidentally was the only starting year with a long-term average real return below 6%. Its best case scenario was an average return of around 8.5% per year, assuming you began investing in 1976 or 1981. That suggests that a $10,000 investment would grow to, on average, around $160,600 over the course of 40 years after adjusting for inflation. At worst, you're looking at an estimate of around $76,000 and at best $261,300. In any given year, the returns have been as high as 36% or as low as -42%. On average, they hover around 7.7%. The Sharpe and Sortino ratios for this strategy were 0.42 and 0.62 respectively. That's the 7th ranked Sharpe and 6th ranked Sortino ratio among the strategies we've covered so far, going back to 1970, suggesting that it hasn't been among the best allocations on a risk-adjusted basis during these years. In fact, it's actually been one of the worst, largely due to its volatility. Next, let's take a look at some of the volatility metrics. The average standard deviation of returns for the Ramsey approach was 17.8%, which means that in any given year, we can expect that most of our returns will fall somewhere between negative 10.6% and 25% with this strategy. The strategy had an excess kurtosis value of negative 2.52, suggesting that the majority of its returns were within a few standard deviations of our average. Roughly 66% of the returns during these years fell within our expected range. Only 9 of them fell outside of that range for the worse. The strategy had a skewness of negative 0.78, suggesting that the majority of its returns would actually be above the long-term average, with a few returns coming in below the average, dragging it down. And as we see in the loss figures, that does appear to be the case. There were a total of 16 years, out of a possible 52, where the portfolio failed to keep pace with inflation in this sample. That's a loss frequency of around 31%. Of those losses, 10 actually fell by at least 10% and 4 by at least 20%. Thankfully, most of those downturns were recovered from relatively quickly, as there were only 2 10-year stretches where the strategy failed to keep pace with inflation. Those were the stretches ending in 2009 and 2010. In both cases, the portfolio trailed inflation by around 1% a year. Next, let's talk about start date sensitivity. Start date sensitivity, at least as we're measuring it in this series, takes a look at the rolling returns of the 10 years prior to each initial investment date and compares it to the rolling returns of the following 10 years to see how big of a difference there is between the two. It's a good way to get an idea of how dependable or trustworthy an investment strategy's returns have been historically. And ideally, we want to keep our total start date sensitivity, measured here by the difference between the largest underperformance and the largest overperformance, as low as possible. The Ramsey portfolio had a total start date sensitivity of 23.4% during this time frame. The largest overperformance was 11.1% per year, which took place from 2009 to 2019, and in those years, the Ramsey strategy had an inflation-adjusted return of about 10% per year, beating out the returns from 1999 to 2009 of negative 1.1% per year. The largest underperformance was negative 12.3%, when the returns from 2000 to 2010 failed to match the returns produced from 1990 to 2000. On average, its start date sensitivity hovered around 4.7%. That just about wraps up our analysis of the strategy's returns. Next, let's move on to our crash analysis. A crash analysis is important to do for any investing strategy you're looking at because it's important to know that if you're going to be putting your life savings into something, you'll be able to weather the storms when they come, financially and otherwise. In these videos, we look at several different metrics when analyzing the crashes. They are the depth of the crashes, how long it took for the portfolio to bottom out, how much the strategy rose and fell relative to the rest of the market, how much of its time was spent in either crash or correction territory, how strong and sustainable its rebounds were, how long it took for the strategy to set new highs, and the Ulcer Index, which seeks to give investors a better idea of what the investing experience will be like by considering the depth and duration of downturns. For the Ramsey portfolio, the deepest and longest inflation-adjusted crash took place from 1973 to 1980, when it trailed inflation by nearly 53% at its worst. Other notable downturns like the dot-com crash and Great Recession were not too far behind, lasting for 6 and 5 years respectively and falling by around 41 to 42% in both cases. The average downturn saw the Ramsey portfolio fall 19.6% from previous highs, with a downside deviation of 12.6%, suggesting that the majority of downturns would see drops between 7% and 32.2% once they eventually bottomed out. Which is not the best in terms of tranquility, but it is technically an all-stock portfolio, so tranquility probably is not the top priority. On average, it takes around 3 to 4 months for the portfolio to bottom out. This gives it a dive rate, or the amount that the portfolio would fall in an average downturn if it continued to fall at that same rate for a full year, of over 65%. When the strategy does recover, it typically does so in a pretty strong way. In the year immediately after bottoming out, the Ramsey portfolio had minimum, average, and maximum rebound intensities of 5.3%, 25.2%, and 36.1%. If we filtered those results to only look at how it bounced back following major market crashes, we see that it jumped about 33.6% the year following a market bottom on average, with minimum and maximum rebounds coming in at 32% and 36.1% respectively. To get an idea of its longer-term resiliency, we can look at what I call the portfolio's comeback magnitude, which measures how much the portfolio grows each year on average between bottoming out and setting new highs. In this case, the Ramsey portfolio's comeback magnitude was 10.6% per year. On average, it took a little over 2 years and 3 months for the Ramsey portfolio to set new highs after bottoming out. This means that on average, downturns from start to finish lasted roughly 2 years and 7 months for this strategy. It spent roughly 33% of its time in correction territory and 22% of its time in crash territory. And its downside capture ratio, which measures how far the portfolio falls relative to a benchmark in the months when the portfolio is falling, was 116% when measured against a total stock market index fund, suggesting that when it falls, it does so more than the market as a whole. On the bright side, when the portfolio was rising, it was doing so at a faster rate than the overall market, scoring an upside capture ratio of just over 100%. This makes its overall capture ratio 86%, suggesting that its strong upside potential was not quite enough to make up for its lackluster downside performance relative to the overall US stock market. So this is definitely a bit of a mixed bag. On the one hand, compared to all of the other strategies we covered in the series so far, with data going back to 1970, the Ramsey portfolio holds the worst mark in each of the crash depth metrics, the dive rate, and the downside capture ratio. On the other hand, it holds the best upside capture ratio as well as the best minimum and average rebound intensities in both the overall and crash-only filters. So what we've got here is a real boom and bust portfolio. When things are going well, they're going really well, and it could even be a really good allocation to hold on to after a downturn has gotten going because of its ability to bounce back. But when things are going bad, it tends to struggle more than other strategies. And this is reflected in the Ulcer Index, which rose to its high as 2.3 during these years, and on average hovered around 1.0. That trails everything except for the all-stock strategy represented by an S&P 500 index fund in both metrics. With that being said, let's move on to examining the strategy in regards to financial independence. Historically speaking, the Ramsey strategy would have maintained minimum 30, 40, and 50-year safe withdrawal rates of 3.95%, 3.73%, and 3.61% during this time period. The worst year to retire using this strategy was 1970, as that's when all these minimums were set. I should note that, as usual, due to the varying natures of individual expense ratios and tax situations, neither has been considered in these withdrawal rates. The median rates were 8.38%, 7.21%, and 4% on the nose for the 30, 40, and 50-year scenarios, respectively. And the maximum rates for the same durations were 10.79%, set in 1976, 10.17%, also set in 1976, and 4.39%, set in 1971. The strategy would have maintained a minimum perpetual withdrawal rate of 3.44%. As usual for this series, I'm defining perpetual withdrawal rate as the highest withdrawal rate that you could have used while still maintaining your original inflation-adjusted principal all the way through to the end of the dataset. In terms of income during financial independence, the Ramsey portfolio generated an average of roughly $156,500 per year on a $1 million nest egg among all available 30-year cycles. The median income was $157,600. Over the first 5 years of financial independence, those figures clocked in at roughly $90,000 a year, and income rose in roughly 99% of all years. The accumulation phase of financial independence is where you're still putting money away for your future. The primary metrics here is what percentage of our income are we saving, how do our expenses change over time, how long do we plan to be retired, and how long will it take us to reach financial independence based on that information and the performance of our investing strategy. Assuming that we save 15% of our income, we're planning on a 30-year retirement, and our expenses changed in line with inflation as measured by the CPI, we would not yet have achieved FI. However, with a 30% savings rate, we would have reached our goal in 22 of the 52 scenarios. On average, it took 37.5 years to reach FI, with the fastest taking 30 years, starting in 1991, and the slowest taking 48 years, starting in 1970. With a 50% savings rate, a hypothetical investor would have reached financial independence in 38 of the 52 scenarios. On average, it took about 18 years to reach FI, with the fastest being 13 years, starting in 1987, and the slowest taking 26 years, starting in 1970. And finally, with an absolutely crazy 70% savings rate, the numbers improve even further, with a hypothetical investor reaching financial independence in 45 of the 52 scenarios. On average, it took about 9 years to reach FI, with the fastest being 6 years starting in 1994, and the slowest being 16 years starting in 1970. The last metric I like to examine under the financial independence banner is the strategy's scalability. When I say scalability, I'm referring to the strategy's ability to scale up or increase its minimum safe withdrawal rates and or FI income metrics when we incorporate drawdown maximization techniques such as cash buffers, financial guardrails, and flexible spending budgets. The more scalable a strategy is, the larger the benefit we'll see in these metrics as more of the techniques are used. So I reran all the simulations for the Ramsey portfolio, assuming that we used financial guardrails, with a 10% adjustment to our projected withdrawal if we ever fall outside of the upper and lower guardrails, which I set to be 20% above or below whatever our initial safe withdrawal rate happened to be. A spending floor of $30,000 a year, which we're not allowed to go below regardless of what the guardrails say to do, unless our investments have fallen by enough for our flexible spending budget to kick in, a flexible spending budget of $24,000 a year, which we'll only be using in the years where our investment portfolio has fallen by at least 20% from their all-time highs, and a 2-year emergency cash buffer, earning 2% interest, which in this case would be about $48,000 in cash on the sidelines, since our emergency spending budget is $24,000 a year. Similar to the flexible spending budget, we'll only be using this cash when our portfolio has fallen by at least 20% from their all-time highs. Here's how the numbers came out. As you can see, there's quite a jump across the board for safe withdrawal rates. A somewhat different story could be told for the income metrics. For the most part, the income figures for the early stage of financial independence looks to be an improvement, but due to the fact that our guardrails would have us slash our incomes more often than before, the overall figures are a step down. So there is a bit of a trade-off at some point after those early years. However, the Ramsey plan in particular is a bit unique in a sense. Like I said, few people argue against the benefits of things like paying off debt, particularly if it's high-interest debt, and we all know that regular budgeting can help us to identify and figure out ways to rein in some of our most undesirable spending patterns. However, if you're following the Ramsey plan to a T, this isn't just some vague notion sitting buried in the recesses of our financial knowledge base. It's baked into the plan. This is a boom and bust portfolio that seems to be built specifically for those individuals who are also following the other tenets of Ramsey's plan. Those who are buying houses either with cash or on 15-year fixed-rate mortgages that cost no more than 25% of their take-home pay. Those who are paying off their debts and not getting back into them later in life. And those who are regularly budgeting their money and making conscious financial decisions, always looking for ways to optimize their finances and not waste their hard-earned money. I bring this up because in this series I've mentioned several times that some of our assumptions we're making to keep things consistent across these videos may or may not actually apply to your individual situation. One of those things is that your spending will rise in line with inflation as measured by the CPI. That probably isn't going to be the case for a great many people following Dave's plan, or just a great many people in general. In fact, over time, due to things like getting their homes paid off early and not having other debt payments, to making conscious financial decisions, living on a written down plan, and deliberately looking for ways to optimize their finances and not waste their money, their expenses may grow at a much slower rate than overall inflation. After all, part of the idea is to live like no one else, so later you can live and give like no one else. So how would these metrics change if we actually accounted for that possibility? Let's say that a hypothetical investor saw their expenses grow at a rate that was 2% less than inflation each year. So they're still growing, just not quite as fast as the overall inflation rate. And we'll assume that they continued to utilize techniques like financial guardrails to make the most out of their golden years. Here's how some of the metrics would change. As we can see, while the first 5 years of income favor this new approach even more, the overall income generated for the duration of the simulation is lower than before we adjusted our personal inflation rate, which is to be expected as we're assuming that we adjust our income each year for inflation. So if our inflation assumptions are lower, so will our adjustments. But the minimum safe withdrawal rates see another sizable jump, to dang near 11.6% in the 30-year case. And this jump leads to a sizable difference in our accumulation metrics as well. Here's how the three variations compare with one another at different savings rates. Comparing the Ramsey portfolio to all the other strategies we've covered since 1976, as that's the earliest year for which I have data on all of the investments, we see that it has some very formidable strengths, but also some very formidable weaknesses. As I said, it's a boom and bust approach. It has some of the best returns, ranking in the top 3 or 4 in most of the major growth metrics, the best upside capture ratio, and some of the strongest resiliency scores, coming in first or second in most of the rebound metrics. And its FI accumulation and safe withdrawal rate metrics came in either second or third across the board. However, it also has some of the weakest tranquility metrics, scoring second to last in terms of crash depth, downside capture ratio, and the ulcer index, as well as dead last in the dive rate since 1976. Now, Dave does say that the only ones who get hurt when riding that investing roller coaster are the ones who jump off. And obviously, as we saw with the FI accumulation metrics, that's very much true. If you're able to ride the waves of this strategy, history suggests that you will do pretty darn well for yourself. And when you're still putting money away, the fact that this strategy dives faster and further than most others, while also taking a little longer on average to rise back up to set new highs, it's not necessarily a bad thing. Assuming you can keep your income in those situations, it means that you'll be able to buy the dip faster than you could with many of the other strategies that we've covered, and that dip would be at an even larger discount, and you'd be able to buy it for longer. That's a pretty powerful combination for accumulating wealth, especially if you're also following the other parts of Ramsey's plan. The key is to ensure that you don't put yourself in a situation where you have to start selling some of your investments when they're down, because with this strategy, they tend to fall more than most of the others when times are tough. So making sure that you do things like keeping your burn rate low by paying off your debts and optimizing your budget, and building and maintaining a fully funded emergency fund are key to making the most of this approach. So in the end, is Dave's investing strategy really all that bad? No, I don't think so. Is it the best for everybody? No, I don't think so. But then again, what strategy is? What seems pretty clear to me is that this approach is geared to trying to make the most for those people who are both willing and able to live lean if the need should arise, and have already actively taken steps to change their behavior with money in ways that will limit their potential downside risk. I.e., they've paid off their debts or are in the process of doing so, they've learned to live well on less, and they have prepared themselves mentally and emotionally to deal with the ups and downs associated with riding the roller coaster of the stock market. And for those people and that goal, it seems to do its job pretty well. But what do you think? Let me know in the comments section below. But that'll do it for me today. Once again, if you enjoyed this video, be sure to smash that like button if you haven't already, subscribe, and hit that bell next to my name so you'll be notified of all my future uploads. I generally upload every single Monday, and if you have a friend that would be interested in this kind of content, be sure to share it with them. Let's really get this information out there and start our own financial revolution.